A couple of things to know for a reconciliation. Make sure that both the bank and the book are at the end of the month, right? It should reflect all the flows. And again, this corresponds to that column of information, the stuff that we think we know, right? That what the banks and the books think they know. So we're here at the end of this month, all the information. The books know all of the checks they wrote, all of the checks that they received. The bank knows all the interest revenue, the notes they collected, the service fees, the NSF checks, and the overdraft fees. And neither will be cognizant of their errors until there's a reconciliation at the end of the month. So if we need to, one of the first things that we do in our reconciliation is figure out how have deposits in transit, that's in transit, not in transit, deposits in transit and outstanding checks changed over the month, right? So there's going to be an amount at the beginning of each month, and then we need to figure out, well, what has the bank recognized and what have the books recognized? So let's do that with this, and it's easier to kind of walk you through it than to say it in words. So we got Poundstone Company. That's the company that is doing the bank rec, not the bank. Has an October 1 book balance of $47,096 and a bank balance of $49,896. So that's the October 1st balance. So we need to be real careful, right? That's not the end of the month. In addition, at the beginning of the month, there's $3,000 of deposits in transit, and there's $2,800 of outstanding checks. And then we have the following stuff that was recorded during the month. The bank recorded deposits of that amount, checks of that amount. The books recorded deposits of this amount and checks written of that amount. So let's start with that information. There's some other stuff that the bank, understands and things that happened during the month of October. But the very first thing we want to do is figure out, well, yeah, we started at $3,000 of deposits in transit, $2,800 of outstanding checks, but that doesn't tell me what the end of the month was. So that's the first question. Determine what those amounts are at the end of the month. So for deposits in transit, we started at 3,000. So on 10/1, we had $3,000 of those guys. And sorry, 2,800 or no. Okay, I'm sorry. I'm just mixed up. $3,000 of deposits in transit, 28 of outstanding checks. Now let's look at how the information differs over the month. Well, for the deposits, we know, remember the company knows, these are the true, this is the actual activity during the month. So we deposited $13,595. The bank recorded $15,545. Now, how is the bank recording more deposits than we know we actually made during this month? The answer is because they started out at an amount of deposits that they hadn't even cleared yet. So they have the difference between these two numbers, 15,545 minus 13,595. That's a $1,950 difference between those two numbers. 15,545, 13,595, $1,950. So now what I always ask myself is, does that mean that the bank caught up or did the bank fall behind? And then that lets me know if they caught up, that there should be fewer deposits in transit, because this number shows these are things the bank has not attended to yet. If the bank has fallen behind, that means there's even more deposits in transit. So in this case, they caught up. The number that they declared as deposits is greater than the amount that the company recorded as actually deposited checks during that month. So since they caught up, we subtract that out from the beginning amount and we get 1,050. So our ending balance of deposits in transit is 1,050. We do the same thing with the outstanding checks. We look at the difference. Well, the company wrote $12,144 of checks. The bank cleared 11,335. So they cleared less. The difference between those numbers is 809. And now, did the bank fall behind or did they catch up? Well, they cleared fewer checks than we wrote in terms of dollar value. And that means that now there's even more outstanding checks than there were at the beginning of the month. Now that we have that information, we do the bank rec. And the way that you reconcile is that you want to make sure that everything is totaling up correctly. You can start, in this case, I give you information about the bank and the books. Let's look at the books. So the books had a balance of 47,096. That's where they started at. And this is good. You're gonna have to write a little small here if you're following along and taking these notes, because I didn't put a whole lot of room here. I apologize. So this is the beginning of the month balance in their cash account. And we'll pretend like all their cash always goes through this bank so that they made deposits during the month, 13,595. Well, that would increase my book balance. I wrote checks of 12,144. That would decrease my book cash balance. So remember, when I'm talking balance, I'm always talking about that check, that cash account. 47,096 minus or plus 13,595 minus 12,144 gives me 48,547. This is my December, I'm sorry, I'm working in October, my October 31st cash balance prior to reconciliation. But this is what the books know. This is their ending cash balance for the month. Once they do the reconciliation, they can start to incorporate the stuff that the bank knows that the books don't. The bank knows they collected a note, right? And I said it's not included in the deposits. So the note that was collected by the bank is $2,400. And now I'm going to take this balance and add to it because I didn't know that they collected that note on my behalf. But then I look at my statement and I see, oh, look, there's $2,400 more dollars there. So I add that. I have a service charge I wasn't aware of. They took 140 away for whatever weird service charge they might have. There's tons of them. So that's cash that I don't have that I didn't know about in this number. And then there's an NSF check of a customer returned by the bank. And that means that we have now $2,224 subtracted because we thought we debited cash and credited a service revenue, let's say for $2,224. Well, that was not cash anymore because the guy didn't have the amount of cash. He wrote a check to us that he didn't have. We subtract that amount off. And now we have our new total after we assess all those things, 48,547 plus 2,400 minus 140 minus 2224. And that gives me 48,583. So this is what I'm calling the true cash balance. It's really a post-reconciliation balance, but it reflects all of the information. The reason why I say it's true is it reflects the information the bank has, it reflects the information that the books have, and it puts it all in one place. What is the entry that I would need in order to set the cash account correctly? So I've done this reconciliation in terms of finding out what the real balance is, but how would I log that into my books? And that's just taking each one of these items that the banks knew that I had to update the books for, those three numbers, and making journal entries out of them. You can, I'm not sure, I don't remember if McGraw has you do this as one entry or separate entries, or if they have you journal it at all. But the way that that would go then is that I'll do them separately and then show you how you can just combine them. The note that's collected, that is additional cash. It added to my account and I credit note receivable. The service fees would be an outflow of cash for 140. And the NSF check, if we've already rendered that, actually it doesn't, we recorded it as cash, we're still due that cash, we would debit an account receivable. But because we recorded it as cash and it didn't pan out that the person who wrote us that check had the cash, we take it away from cash, but we're still going to go after them and get our money. And this is a practice that I'm doing on the side that I force my students to do when I grade tests in person. And it's just, you should be able to, for every account, it's part of understanding the account versus just memorizing a journal entry. Understand what's being affected here. It reinforces that connection of how everything's classified and gives you a sense of, is this an asset for an asset transaction, right? Some assets are going up because other assets are going down, as in the first and the third entries here. Or is this an asset that's going down and it's going to show up as an expense on the income statement, right? Because you go into intermediate 2, there's not going to be a review of the balance sheet income statement. That instructor is going to assume all the stuff that should go on an income statement and all the stuff that should go on a balance sheet and why they go there. I'm going to pause right here because it just real quickly. Are there any questions about what I've done so far? Bank recs, in particular, any of the operations I performed on this problem? All right, got some silence. So that's a bank rec.